At this point, I'd like to turn the proceedings over to Dean Dunkelberg, our former chairman of the board of the GIC. And Dunk, we'll invite the panel up.
I see the panel moving. Yeah, I did have the honor of being the chair of GIC for 20 years. Went by fast. It was enjoyable, but got to move over and let the young people take over. And trust me, I'm not one of them, unfortunately. Well, we have an exceptional panel for you now. Our first speaker will be Dr. Manuel Sanchez Gonzalez, who is vice chair of Banco de Mexico, so he knows a lot about banking and, of course, development, economic development, and the importance of trade since he's in Mexico. And Dr. Roberto Coronado, who is assistant vice president and senior economist at the El Paso branch of the Federal Reserve Bank of Dallas, one of my favorite Federal Reserve branches. And then, if there's any time left, I'll talk. I'll be the third one on the agenda. So I urge you to read the introductions here. I'm not going to go into the detail. These are exceptional people, and it takes a long time to talk about all the things that make them exceptional. So I'm going to start now with Manuel Sanchez, and he'll lead us off, and then we'll go to Roberto, and then I'll talk. Thank you.
Good morning. Thank you for this nice introduction. And let me thank you for inviting me to participate in this 2014 Southwest Economic Summit. It's very pleasant to be, for the first time in my case, in this very beautiful city. So I really appreciate the opportunity to be with you today. I find this summit very, very timely, as it is devoted to the discussion of the economic effects of international trade, and we are celebrating the 20th anniversary of NAFTA, which is a nice opportunity to think of the economic effects that NAFTA and in general the opening of our economies have had in our countries. I would like to talk a little bit more about my country, because that's the subject that I know a little more, and I feel obviously more comfortable to talk about Mexico. But I will refer to certain things about the United States, which is the largest, our largest trading partner, obviously, for Mexico. Being a developing nation, Mexico in particular has gained from the opening of the economy and NAFTA in terms of higher consumer well-being, which also includes output expansion and efficiency, among many other benefits. And yet, in spite of this more dynamic economic and trade activity, I should say and recognize that our economy, in terms of long-term performance, has left a lot to be desired. And that is to say, the long-term economic performance of Mexico during the last 3 decades continues to be a little bit less than satisfactory. But fortunately, the ongoing structural reforms that I'm sure you have read about them on the newspapers, enhance the possibilities for progress, as they are intended to tackle Mexico's most important drag on long-term economic growth, namely stagnant productivity. Our economy lacks a lot of efficiency, and that's the factor that we believe is behind the low growth that has been our economy experiencing during the last decades. And on the other hand, the country is currently undergoing an economic rebound that faces challenges, including those from less favorable external financial conditions. I'm going to talk a little bit about that also. So let me organize my remarks as follows. First, I would like to briefly review the impact of Mexico's economic integration to the United States and to the world economy. And second, I would like to highlight some features of the current momentum on structural reforms that hopefully will interest you. Third, I will discuss the economic outlook, and finally, I will provide a few remarks on monetary policy and inflation. Being a central banker, I should talk about monetary policy. There is no way to avoid that subject. Let me begin with the first subject very quickly. Since the middle of the 1980s, Mexico has implemented a strategy of gradual trade liberalization in order to modernize the economy and enhance the possibilities of economic growth. That was even before NAFTA. As you probably remember, the first steps were unilateral, consisting of across-the-board reductions of import tariffs and non-tariff barriers. This policy was strengthened by Mexico's incorporation in the General Agreement on Tariffs and Trade in 1986. External liberalization was later deepened through a number of free trade accords, among which obviously NAFTA stands out. Mexico's economic opening was mainly in foreign trade, although notable steps in removing obstacles to foreign direct investment were also undertaken. The recent lowering of import tariffs for nations with which Mexico doesn't have any trade agreement has also increased the openness of Mexico to the world. Certain effects from more trade seem to be very clear in the case of Mexico. By far, the most evident and crucial benefit has been greater consumer welfare, the ultimate end of any economic policy. The reduction of trade barriers has provided the Mexican consumer with a wider variety of higher quality goods at lower prices, many of them completely unavailable when the economy was closed. And that reminds me about 30 years ago when I went back to Mexico after studying in the US, and I went to look for a tape recorder. You remember that those things existed, tape recorders, those little. And I went to a big department store asking for a tape recorder, and how do you say, the attendant looked at me very, very strange and said, no, there is no way you can buy a tape recorder here in Mexico. You have to go to the US, but perhaps you have to do it illegally because that's prohibited. You know, that's amazing, but that was just about 30 years ago. And now the consumer obviously has a very wide variety of goods comparable to the varieties that you people have in this country. Behind this development has been a considerable expansion of merchandise exchange with the rest of the world. During the last 30 years, total trade value defined as the sum of exports plus imports relative to GDP has tripled to reach about 60% of the country's production. NAFTA seems to have contributed to the enlargement of trade not only with Mexico's North American neighbors, but also with nations from other regions. In fact, there is evidence that trade diversion resulting from this preferential agreement has been relatively low. Basically, we have had a lot of trade creation and very little, according to the data, very little trade diversion. The observation is confirmed by the fact that during the last 10 years, the importance of shipments to the United States, although those have been very, very dynamic, relative to Mexico's total non-oil exports has, in fact, declined. NAFTA has given us the opportunity to trade with many other nations. We became a little more attractive, thanks the United States and Canada. So that's sort of a paradox that you probably, something that you probably were not familiar with, or you hadn't heard of that. At the same time, trade opening resulted in a significant change in the composition of exports, from one based on oil to one made up mainly of manufactured goods. within this transformation, the share of high-tech products have been gradually increasing. Growth in exports has occurred in tandem with that of imports. The vertical integration of many firms in the North American region has implied significant growth of intermediate good imports, which, along with capital imports, accounts for the majority of the purchases from abroad. Less dynamic and less dramatic, but also clear, has been the contribution of economic opening to greater FDI. On average, during the last 20 years, FDI relative to GDP has been twice as large as the average observed 10 years earlier, although this ratio still remains well below those of leading recipient countries. Hence, there is a very important, according to us, very important upside that the economy has still. Also, during the most recent past, the proportion of flows coming from the United States has been decreasing, although the FDI flows from the United States have remained very, very dynamic. But again, that's a case in which Mexico has benefited from being part of the North American Free Trade Agreement. In addition to the impetus from NAFTA, other factors such as the liberalization of FDI restrictions in several areas, such as the financial and telecommunications sectors, contribute to explaining these larger inflows. Through FDI, new firms have been established in the country, including those oriented to providing services. Usually we think about only manufacturing firms, exporting from Mexico or exporting from the United States. But also there has been a lot of FDI going to services-oriented firms, and companies have been able to adopt new technologies and modernize their productive processes. There is some evidence that the sectors more engaged in international trade in Mexico have enjoyed increasing efficiency. This seems to be largely the result of import competition and access to foreign intermediate inputs. Also, some studies suggest that FDI has contributed to an increase in total factor productivity. Greater efficiency, in turn, has tended to support relatively higher wages in the sectors most exposed to international trade. Mexico's integration with the United States has been strengthened with the opening of the economy. This effect, along with Mexico's sounder macroeconomic policies, has resulted in an increased synchronization of its business cycles with those of the United States, thus making the economy relatively more stable than in the past. Let me move on to the second subject, which is structural reforms. And as I said, in spite of the benefits from economic liberalization, Mexico's long-term economic performance has been less than stellar. During the last 3 decades, per capita GDP growth has been below half that of the United States. This is surprising, given that Mexico's stage of development should translate into a wide range of profitable opportunities, the exploitation of which could presumably increase potential growth rates. Several analyses of Mexico's per capita GDP growth based on factor and productivity decomposition confirm that the main impediment to more dynamic output is stagnant productivity. Moreover, examination of sectorial productivity suggests that common factors in the lagging segments of the economy include low competition, poor contract enforcement, and burdensome regulation resulting in widespread informality. Current momentum for structural reforms in Mexico, I believe, is a very welcome development, as the reforms include some measures that may tackle inhibitors of productivity in key sectors of the economy. The transformation agenda encompasses several areas, including labor, education, financial intermediation, telecommunications, and energy. The legislative changes incorporate the regulation in the labor market, the protection of creditors' rights, and the exposure of sectors to competition where the entry of private participants is either completely banned such as in most areas of the energy sector, or restricted to different degrees, such as in telecommunications. As regulation improves and obstacles to competition diminish, higher efficiency may emerge in related areas with eventual benefits for the consumer in terms of higher quality and lower prices for goods and services. It is worth noting, however, that as with any other structural change, the intended benefits depend crucially on the quality of the rules and their adequate implementation so that participants view the new framework as clear and reliable. In particular, secondary legislation is pending for the energy, telecommunications, and financial system reforms, and these norms need to facilitate participation and competition. We should also recognize that although a revival of private investment may occur in sectors such as energy in the not too distant future, productivity effects and eventual consumer benefits will likely become evident only over the course of several years. Now I would like to talk a little bit about the outlook. In the year beginning in the 2012 third quarter, the Mexican economy underwent a process of deceleration. The main factors behind slowing GDP growth were weaker export demand from all regions, including the United States, and a contraction in domestic investment largely driven by deterioration in construction. Shrinking construction, in turn, reflected reduced public expenditures associated with the change in administration and lower private housing investment linked to major developers' financial problems. Since the middle of 2013, there have been signs of economic upturn. GDP grew in the third quarter and continued to expand in the fourth, though at a much slower pace. A source of improvement has been more dynamic exports as the U.S. economic recovery has gained steam, and lately the normalization of public expenditures. Consumption apparently continued to grow in the fourth quarter, as suggested by the performance of services, production, and retail sales. The labor market provides other encouraging indicators. Formal employment has maintained a positive trend, and the unemployment rate has fallen to its lowest level since 2009, even though it remains well above pre-crisis averages. Despite this progress, the rebound remains fragile, as shown by very weak fourth quarter GDP growth. Investment has extended a declining trend, with deceleration involving not only construction, but machinery and equipment purchases as well. Also, consumer confidence has been falling since last year and recently more sharply. Analyst consensus posits a gradual recovery for the Mexican economy this year and next. Elements that may support these forecasts include better expected economic prospects for the United States and the reactivation of government investment. However, there are downward risks to this scenario, including further decline in consumer confidence, the time needed to restructure the housing developers market, and less favorable external financial conditions. Regarding the third factor, expectations of the tapering of U.S. Federal Reserve securities purchases last May brought about an increase in global risk aversion, reducing the prices of many financial assets, especially those of emerging markets, which had been favored in the previous 2 years. Although volatility declined by the end of 2013, partly as a result of lower uncertainty after the Fed finally did announce its decision to start reducing its asset purchases, risk aversion has returned in 2014. The recent deterioration of global market sentiment has once again translated into a flight to quality away from emerging markets. Some countries with significant macroeconomic imbalances, high inflation, and political upheavals have been hit severely. Heightened risk aversion apparently reflects uncertainty on the pace of the future unwinding of monetary stimulus in advanced nations, lower growth prospects for emerging markets, notably China, and the unknown capacity of vulnerable developing countries to undertake needed adjustments. Although emerging markets as a group have been affected negatively, there has been some differentiation in investors' appetites among specific economies. So far, Mexico's financial asset prices have been relatively less affected, and the availability of foreign financing continues to be ample. Yet, the country cannot take the present situation for granted, since market sentiment can deteriorate further at any time. In the face of such an eventuality, the best strategy for Mexico is to buttress its economic fundamentals, including fiscal discipline, financial and price stability, and productivity-enhancing reforms. And finally, a few comments on monetary policy. For more than a decade, the Bank of Mexico has implemented its monetary policy within an inflation targeting framework. Since 2003, the permanent objective has been 3% annual inflation with a variability interval of plus or minus 1 percentage point around this target. The interval is not an objective or an indifference range, but a reflection of the inherent volatility of the non-core components of the National Consumer Price Index. Throughout these years, there has been a considerable progress in the convergence of general inflation towards the 3% inflation target. In 2013, the Bank of Mexico lowered its policy interest rate by a total of 100 basis points in 3 cuts, leaving it at its current 3.5%. The reasons for these adjustments were previous gains in the reduction of inflation and the softening of economic activity viewed as consistent with diminished foreseeable inflation pressures. After a slight decline in average annual inflation, price growth picked up at the end of 2013 and surpassed the upper limit of the variability interval in January. The main proximate causes of the recent rise in inflation were increases in public transportation prices and tax hikes approved for the present year. Although by nature, these elements will likely exert only transitory effects on inflation, future price developments should be monitored carefully. In particular, the balance of risks for inflation has deteriorated. Some factors to watch are the fact that analysts' short-term inflation expectations have recently risen. Inflation will likely exceed 4% for several months this year, and second-round effects cannot be ruled out. Furthermore, additional financial volatility could put pressure on the exchange rate with some pass-through on inflation. These considerations are all the more important as inflation expectations for all terms remain above target. The Bank of Mexico expects inflation to return to the convergence path towards 3% by next year. In any case, the governing board of the Bank of Mexico has repeatedly stated that it will remain vigilant in order to detect elements that may put convergence at risk and act appropriately. And with this, I would like to close my remarks.
Thank you.
Thank you.
Dr. Coronado, you're next. You can there or here.
Well, good morning, everyone. I would like to take this opportunity to thank the conference organizers, in particular Peter Gold and Ben Craig, for inviting me to participate in this outstanding conference. It's an honor and privilege to be part of this wonderful program and also to share the panel with 2 superb economists that I have great admiration to. Today, I will concentrate my remarks on the role that the border region, in particular the Texas-Mexico border region, has played over the last 20 years since the North America Free Trade Agreement has been in place. In my speech today, I will argue that NAFTA has not only increased bilateral trade flows and business cycle synchronization, something that Deputy Governor Sanchez already mentioned, between both the U.S. and Mexico, but that NAFTA has also changed the economic landscape of the border region, and I would suspect that to some extent that applies to Phoenix and the metro area here. In addition, I will argue that the border region now plays a critical role in the North America market. So let me go ahead and get started with my presentation. This is the outline for my remarks. I will begin my remarks by discussing bilateral trade flows between both nations and business cycle synchronization, as I mentioned. I will then shift gears into a more regional perspective and look into trade flows between U.S. border states and Mexico. And after that, I will discuss the role that the border region and as well as the maquiladora industry has played in the North American market during the last 20 years or so. I will show specific evidence that NAFTA has been one of the main catalysts behind the evolution of the border economy. And by evolution of the border economy in this particular case, I'm referring to a migration from a manufacturing-based economy, border economy that is, into a more services-oriented border economy. And then, of course, at the end, I'll provide some concluding remarks. I'm afraid I will not be the only speaker today that will probably be showing a similar chart to this, or a similar version of this chart. On this chart, I'm plotting bilateral trade between the U.S. and Mexico. And this is total trade. This is exports plus imports. Today, bilateral trade between both nations exceeds $500 billion per year. That it's $1.4 billion per day, or $1 million per minute. So in the next 13 minutes that I have on the agenda, both the U.S. and Mexico will engage in trade flows in $13 million. For the U.S., as we know, Mexico is the third largest trading partner after Canada and China. For Mexico, on the other hand, the U.S. is by far the top trading partner for Mexico. In this chart, I have marked two significant milestones. In 1986, Mexico joined the GATT, now the World Trade Organization. And of course, in 1994, NAFTA was born. Between 86 and 94, total bilateral trade in between these two nations increased by a factor of 2, more than 2 times the growth increase over this period. Since NAFTA has been in place, trade between both nations have increased by a factor of 3.5 times. So terrific, outstanding growth in trade because of NAFTA. Now, in this chart, what I'm showing you is that the composition of these bilateral trade flows. In particular, I have the top 10 trading sectors between trade between both the U.S. and Mexico, and I'm using 2 years as a reference, 1996 and 2013. There are 3 main takeaways from this chart. First, while trade between both nations has increased dramatically from $130 billion in 1996 to $507 billion last year, the composition of trade has not changed drastically. And in fact, if you look at the distribution of both pie charts, they look pretty much the same. The second point I want to make is that the trade between the U.S. and Mexico is mostly within the same industry. It's what economists we call intra-industry trade. And the third point, and perhaps the most important point that I have to make, is that transportation equipment, automotive sector, is today by far the most important trading sector between both nations. In fact, last year alone, both the U.S. and Mexico engaged in trade in the transportation equipment over $80 billion worth of trade. That is 16% of these bilateral trade flows that exist between both nations. So speaking of autos, let me take this opportunity to share with you a few statistics that will help us better understand the role that Mexico plays in the North America auto production sector. Now, we have in this room experts on the automotive sector, so please, for those of you who are experts on this sector, please bear with me the next couple of minutes. At the Federal Reserve, we have tremendous expertise on the North America automotive market, in particular the Chicago Fed. So in this particular slide, I'm actually citing the research of a couple of colleagues out of the Chicago Fed, in particular Tom Clear. Today, Mexico exports over 2.5 million units. These are final assembled vehicles into the world. 75% of those come to North America, the US and Canada. Today, roughly 1 in 5 autos produced in North America are produced in Mexico. In 2008, actually, Mexico displaced Canada as the second largest producer of automotive sector in North America. Mexico is also a big player in auto parts. Roughly 1 in 3 auto parts imported to the US come from Mexico. and a significant portion of those imported auto parts are produced along the US-Mexico border in the so-called maquiladora plants, and I'll return to them in just a second. Economists have been fascinated by the fact that there has been a tremendous growth in trade flows between both nations after NAFTA. There are numerous studies that looked into the economic implications of this significant growth in trade, but in particular, there's a lot of attention that has been placed on studying whether increased trade flows actually lead to stronger business cycle synchronization. And again, Deputy Governor Sanchez briefly talked about this. And in fact, the leading experts in this field are Banco de Mexico economists, colleagues of Deputy Governor Sanchez. And the research indicates that NAFTA has, of course, increased trade significantly, but then this in turn has resulted in stronger business cycle synchronization between both nations. This chart actually corroborates this empirical finding, and in here I have year-over-year growth rates in US industrial production, and I'm excluding high-tech industrial production in the US. So it's sort of a blue-collar industrial production for the US, and Mexico's GDP growth. By simple visual inspection, we can see that after NAFTA, both lines become more synchronized. For those of you in the audience that like statistics, the correlation coefficient prior to NAFTA is 14%. The correlation coefficient post-NAFTA is 64%. So this clearly suggests that both economies now move more in a lockstep fashion than prior to NAFTA. So now please allow me to shift gears and offer you a more regional perspective of NAFTA and its implications. As I said before, Mexico is the third largest trading partner for the US. However, if we looked into US border states, we see that Mexico plays an even more critical role. At the state level, unfortunately, we don't have very good import data, but we have very good export data. So we typically rely at the state level on export statistics as the way to measure about trade flows between states and different nations. On this slide, I show exports to Mexico from each individual US border state and how significant those exports are as a share of total state exports. For instance, in 2012, Arizona exported to Mexico over $6 billion worth of goods and services. These exports represented 34% of Arizona's exports. And in fact, very recently, the International Trade Administration has published data at the city level. And Phoenix, I was just checking the statistics a few minutes ago, but Phoenix exports to the world $11 billion per year. 16% of those exports, Phoenix-based exports, go to Mexico. And so for California, Arizona, and Texas, and Phoenix, there's no better consumer for goods and services than Mexican nationals. Mexico is the #1 trading partner for these three border states, and as well as Phoenix. Now, for New Mexico, it's a different story. And in fact, in the audience, I believe we have representatives from Intel. And they can tell you more into detail what's going on in Rio Rancho, New Mexico, and how Israel is #1 trading partner for New Mexico, and Mexico actually comes in second place. So let me briefly talk about Texas, given that I'm coming from Texas. But again, a lot of this applies to Arizona, and a lot of this applies to California. This chart shows Texas exports over time. We can see that a third of Texas exports go to Mexico. Again, there's no better consumer for Texas goods and services than Mexican nationals. The same applies for Arizona and California. And we can see just the dramatic growth of Texas exports post-NAFTA. Now, allow me to go back home to the US-Mexico border region. As both nations have been engaging in far more trade flows and in an ever-increasing business cycle synchronization, the border region has been at the core of this process. At the end of the day, border communities are either the entry or exit of merchandising people coming and going from the US. So it would be fair to say that most of the action actually takes place along the border. Having said that, there's one particular industry that dominates the economic activity along the US-Mexico border, and that is the maquiladora industry. For those of you who are not familiar with the maquiladora industry, a maquiladora plant is a manufacturing plant that temporarily imports supplies, parts, machinery, and equipment required to produce goods and services in Mexico duty-free as long as the output is exported back to the US. At the Dallas Fed, we have performed numerous studies trying to estimate what is the role that the maquiladora industry plays, not only in the Mexican economy, in the U.S. border region, but in the U.S. economy as a whole. And our research indicates that the maquiladora industry, it's critical, not only for Mexico, but for the U.S. industrial sector. Furthermore, our research indicates that the maquiladora industry plays a significant role in creation of jobs along the U.S. border cities. In this particular slide, I'm showing you just how significant this industry is for 4 metro areas along the Texas-Mexico border. So our research indicates that 1 in 4 jobs created in El Paso, where I'm coming from, 1 in 4 jobs created over the last 20 plus years can be attributed to the maquiladora industry. And a lot of border communities depend heavily on trade flows and manufacturing taking place in northern Mexico. Most of these jobs that are created as a result of the increased trade integration and maquiladora activity in Mexico is due to or are concentrated on the service side of the economy. And this takes me to my last point, the evolution of the border region. As a result of the stellar growth in the maquiladora industry, we have seen that the economic landscape along the border region, not only Texas, but across the US-Mexico border region, has been changed drastically. Economic activity, as I said before, has been migrating from manufacturing into services, to the service side of the economy. And as you can see, the share of services-related jobs in these 4 Texas border cities have increased dramatically. Today, 90% of the jobs along the Texas border are in the service-oriented sector. And these jobs typically come with higher paying wages and salaries. And this, as a result, has helped close the existing gap between per capita income levels of the border cities and the US in general. So just to conclude, in my presentation today, I've argued that the US-Mexico trade flows and business cycle synchronization have increased tremendously since NAFTA. I've also argued that the economic landscape of the border region has changed drastically as a result of more trade and more business cycle synchronization between both nations. But in my opinion, what is even more encouraging is that the border region is now a critical element, plays a critical role in the North America market. I don't want to leave you with a rosy picture of NAFTA and the border region. There's clearly a lot of challenges and opportunities as well going forward as NAFTA continues to be implemented and embraced between the 3 nations. Just to name a few, I mean, at the end of the day, the North American market will continue to face significant, tough global competition as far as manufacturing is concerned. And so the border region will have to learn how to deal and cope with this tougher global manufacturing competition. Infrastructure, I think President Obama, President Peña Nieto, and the Prime Minister of Canada met last week in Mexico. And infrastructure was at the top of their agenda. If you looked at the border infrastructure, there has unfortunately not been a lot of investment over the last 20 years, and nonetheless, trade flows between the nations have increased dramatically. So infrastructure is a key element that we need to address going forward. And at the end of the day is education. To the extent that 3 countries individually and collectively engage in better education outcomes, I think the North America region will be more productive, more efficient, and more prosperous. And with that, I would like to turn it over to you, Bill. Thank you for your time.
Thank you. Okay, saving the best for last. Just kidding. Okay, well, I'll have a fairly short presentation, and that's where it'll start. Well, if you look at small business in America and look at what that economy produces, it has about 6 million employer firms, and depending on how you count one-person firms, as they have a lot of variable economic activity, it accounts for about half of private GDP and about half of private sector employment, which makes it like the 3rd biggest kind of trading block in the world. It's absolutely huge. If you think about how the United States looks, it's really 50 countries, all right? And the reason there's so much trade, of course, between these countries is it's easy. There are a lot of commonalities, which I won't review here. So there's actually a lot of trade going on, which, you know, when you think about California, Texas, and New York being among the 10 largest countries in the world based on GDP, a lot of foreign trade really isn't foreign because of the nature of the U.S. and how we grew and how we developed. So we actually do a lot of trading, but we don't really look at it as foreign trade. And the fact that we do so much does relate a lot to the fact that it's easy. And of course, the barriers to trade for many of our small businesses, that it's not as easy as trading from Arizona to California or to Texas or whatever. So I'm going to just take you through a brief look at how the small business sector is doing and then talk about the impact of trade. So this is our job, right, to tell you where we are and which way we're going. A friend of Kotak once looked at this and said, neither outcome is desirable. That is, both of them are difficult, whether you're going out one end or the other. So we have a lot of difficulties to face. The blue line here just shows you growth in GDP. You can see the Great Recession, allegedly the Great Recession. That's done very nicely. So we're producing a lot more GDP today than we did back in pre-recession times. But look at employment. Employment is still 1 million or more lower than it was at the peak in 2007. A lot of people think that that was due to productivity, but really it's due to a change in the composition of GDP, much more manufacturing output. A lot of it's exported, which is why it's very important for this conference. And also, there was a change. This just shows you our slow recovery in employment. Sorry, I should have given that to you. So you see we're lagging really badly, getting back to the break-even line. Look how long it's taking in terms of months down there. Anyway, a lot of what's happened to us is really due to housing, as I'll show you in a second. So you can see consumers are not very optimistic, so they're still not spending a lot of money. We need them to stop driving the car for another year and actually go buy one. And this is the kind of thing that consumers who are not optimistic really are slow on their spending. You can see here what happened to housing, of course. So we have a lot of decline in starts. Starts need to get back to at least 1 million, but 1.5 million would be the long run, so we've got a long way to go. And this is missing from our GDP numbers, you know. So we had 1.5 million starts. Now we'll be lucky to hit 1 million rate, maybe a little more than that this year, but that's a lot of GDP and a lot of jobs, and that's one of the reasons we have so many missing jobs. Home ownership rates, you can see it peaked with all the government help that we had. Barney Frank wanted to get everybody into affordable housing. He couldn't do that, so he got us into unaffordable housing, and that's why we're seeing this adjustment. So looking at the small business optimism based on NFIB's 350,000 members, we've been surveying them, a random sample of them for 40 years, so you get an interesting perspective. You can see here that optimism from an historical point of view is still not very high. So we have not really recovered where we ought to be. So small business owners are not very optimistic about the future, and consequently, they're not going to spend a lot of time or spend a lot of money and do a lot of hiring. Is now a good time to expand your business? Where you can see for years now the answer has been no. It's not a good time to expand my business. You can see historically where we should be. Look at those peaks. We're nowhere near there. So we're running around 8 or 10% saying it's a good time. It should be double that, sometimes triple that, especially in an expansion. This is what we asked them, well, if it's a bad time to expand, which about 70% say it is, well, what's the main reason? And of course, the top reason is weak sales and the economy's not doing well. But the number 2 reason is this: political uncertainty. I just don't know what's going on in the future, so I'm not going to bet my money until I'm more certain about where things are going to go. Outlook for business conditions. 6 months from now, you think business conditions will be better or worse than they are today? Look, we got 10 percentage points more saying, 10, 12 percentage points more saying, I think it'll be worse, then think it'll be better. Well, again, that's not really conducive to a lot of spending and hiring and investment. You can see here where you and I stopped spending money back in the fourth quarter of 2008, so we're the ones who really took the economy down. We quit spending. Not only did we build too many houses in the 2003 to 2007 period, but opened too many restaurants, too many little strip malls, too many new little retail outlets, too many. We built way too many firms, and of course we lost 800,000 a year for 2008, 2009. So lots of firms went out of business, and the jobs went with them. So sales are starting to get back, but you can still see the sales performance quarter on quarter is still not very good. The trends are slightly negative, and we need to at least see positive numbers there. What is the most important problem facing your business today? It's not credit. It was back when Volcker was in, but you can see we went through the credit crunch on Main Street without really having people complain about it. We know they complain when it's a real problem. Why aren't they complaining? Well, here's the answer. We have a 40-year high percentage saying that I'm not interested in a loan. Why? Well, what do I do with the money? My outlook for the future is grim. I need to invest that money, if I borrow it, in something that'll pay back so I can repay the loan. That's the custom anyway. And I don't see it happening. So until that really changes, you know, there's not a problem borrowing. I'm the chairman of a little bank in New Jersey, and I can tell you, we need applicants. You know, that's our problem. We all have money to lend, we just don't have people to give it to. No inflation, the Fed's right. You can see back in the olden days, as high as 70% of our firms were raising prices in the pre-83 period. A lot of you look too young to remember pre-83 periods, but you know, there they are. And you can see we, of course, in 08, in the first quarter of 08, we had another energy spike problem, scare. But by the end of 08, we were cutting prices like crazy to get rid of all the inventory that we'd put into our firms, our too many firms, because you and I were spending 99 cents out of every dollar that we earned, and that was not good. Inflation, of course, is the all-time winner for problems, and it is not a problem now except for that little energy spike, which we took care of very quickly by having a big recession. You can see capital spending is improving, but still weak, and that's what we need to raise worker productivity going along. We need to really see that improve, and we had a decline in the last survey, and the January survey, of the percent who plan to make capital outlays, so it's not good. So now let me talk about trade, finally, why that's important. So a couple of years ago, we did a study of our members to see how many people were engaged in trade and what that picture kind of looked like. And you can see here that we had about 13% who said they had some kind of foreign sales that they were engaged in, so I would call that kind of trade. 29% of those were, not surprisingly, in manufacturing. Now, that's direct. Now, a lot of our manufacturing firms, of course, are in Ford's supply chain. I mean, so we're in somebody's supply chain making stuff. So indirectly, we're involved in trade, but not directly doing that. You can see some information on the direct side. For those who actually are directly exporting, it was under 5% of their sales for 70% of those who were engaged in foreign trade. That's 70% of the 13%. Our biggest market was Canada. Second was Asia, collectively. Mexico was at 13 and 12% to the British Isles. Now, all those numbers, I'm sure, are bigger. If we do this study today, which we probably will one of these days, we'll update it again and see what's going on. So that gives you kind of what I think is a minimum picture where this has gone. It's looking a lot better now. So you can see that 13% made direct purchase overseas, and 25% of those were in manufacturing. Transaction costs are high, but you know, technology and changes in transportation costs have made this a much more lucrative market for small businesses to get engaged in. But you know, managing overseas is tough, getting information is tough, finding customers overseas is tough. All those things that are easy among the 50 countries that make up the US, which is why small businesses tend to be focused there. And of course, also, most small businesses are in the services sector, so we don't export haircuts and you know, nail salon output and so on. That's all very domestic, so we don't get involved in that at all. Every 4 years, we ask them, we give our owners 75 things to rank as your most important problem. And of course, no surprise, healthcare costs is number 1, uncertainty about the economy is number 2, energy costs number 3, uncertainty about economic policy is 4, and regulation and red tape is 5, and 75th is trade. No surprise, because most of us can't be involved in that, so that's why it's ranked 75th. But obviously, it's going to be a growing opportunity for small businesses, and even though the government is not a big player for small businesses who export, only about 5% actually go to the government for any kind of assistance, for funding or whatever. I think we'll find that that's a growing market for small business in America, which of course will be helpful for employment growth and growth and productivity in the future. And let me stop there. So we have a few minutes left. Let me see how much we have. Oh, we have more minutes than I thought. I was really fast. We'll post those slides on the website so you can have them. Feel free. And I have many more if you're interested in the stuff that we do at NFIB. So let me open the floor to you for questions, because you've got some real talent here. You don't want to let them get away. There's a question right there.
Big of a factor is technology increasing use of technology, do you think that would be a big help to your members?
Well, yeah, the answer to that is, of course, yes, it would be. Let me point out to you that we've been doing these surveys since 1973, and we still do them by mail. And I can't remember if it was the mayor or somebody who pointed out why that's the case. Most small businesses are probably run by old people like me. We're not technologically too cool. And until we flip these over to young people who really are very aware, they're not going to have websites and things like that. So we don't do the surveys on the internet because most of our people we can't connect to through the internet. Kind of interesting. I did a 3-city tour for a big technology company, Motorola, a couple of years ago, and I was astounded at when I would go in to see all the stuff, the display stuff there, you know, cop in a box, this and that. I mean, the technology available to small businesses is immense, and it's a very backroom saving. You can do inventory so easily now, and your security and your heat controls. I mean, so it's going to be very important, and certainly raising worker productivity. I'm not sure that there's much we can do for a barber. You know, I mean, maybe. I did find a hamburger machine now made in San Francisco that can make about 300 two-order hamburgers without any people involved once you put the stuff in. So, you know, that's coming. And of course, if we raise the minimum wage to $10, there'll be a lot more incentive for us to use technology to replace labor, and that's unfortunate. Other questions? We've got, here we go, right over here. We'll follow the microphones.
Just a question. Yeah, just a question of your perspective on this. We spoke a little bit about NAFTA and cross-border trade, United States, Canada, Mexico, et cetera. Well, one of the administration's big projects is to try to get this free trade zone, somewhat of a free trade zone established between the European Union and the United States to bring down the barriers quite a bit. It wouldn't be quite as extensive as the free trade within the EU countries, which is no borders now as far as trade, goods, services, people. But it would reduce them quite a bit between the U.S. and the EU. I'm wondering how you think that would impact the economy, what the chances are of that going through, and what you know about that. Thanks.
Roberto, you want to start with that?
Sure. I mean, clearly, I think that the evidence is overwhelmingly that once you open up for trade, you all of a sudden have a lot of opportunities to sell and buy goods and services across borders. And so to the extent the U.S. can engage in something like this will be beneficial not only to the U.S. but to the North America market. And I think that's something that we've learned tremendously from Mexico, as Mexico has engaged in significant number of free trade agreements with a number of different countries, is that it's not only beneficial to Mexico, as Deputy Governor Sanchez said, but it's beneficial to North America. So it's countries going in groups and going in blocks, trying to expand and open up their borders. Now, to the extent whether the administration would be successful or not, that's hard to say. But from an economist perspective, that's something that we should be looking into and should be very encouraging going forward.
We're not sure what's making that noise, but Governor, you want to?
I will just add that, you know, this is an approximation to I think an ideal world in which multilaterally you open all the economies to international trade. But in practice, we have been going through these preferential agreements as a matter of a practical thing. But if you open the U.S. economy and the North American region to other blocks, certainly, as Roberto said, will benefit all the signing members. And also, I would say that will help all countries to exploit the opportunities. But that said, I will still think that the North American countries will continue to exploit the natural advantage of the closeness. That's not something that will. I don't envision that as something that may weaken the trade relationships that we already have, but something that will make them even stronger.
Okay, you've got the next one.
Yes. Thank you. For Dr. Sanchez, thank you for your presentation. I had a very good friend, Mexican friend and mentor a long time ago, that said that Mexico needed to grow 5% in real terms per year in order to absorb the labor force growth. Is that number, and that number was 5%, correct? Mexico has been able to grow 5% only twice in approximately the last 20 years. And those 2 times were only because they were recovering from recession. Has the Bank of Mexico done any sensibility analysis to what would be the potential impact of all these reforms to see if that number can be achieved in the next several years?
Well, the bank has, the bank staff already has some estimates of the potential growth rates that we may achieve once they are, from structural reforms, provided that they are well implemented. That's an important caveat. But I would say that they are, well about 1 percentage point above what is the long-term, the net gain in the long-term growth is a little more than 1 percentage point that on a sustained basis for Mexico that will certainly help absorbing the labor force, as you say. But it's very important that, the estimate is very much open to the quality of the secondary legislation that we are still, the Congress still working on.
Jill, our next question is where? We need to get a microphone down in the middle here, if we can. Pass it down over the rows. There we go. Okay, here's a question.
In the first panel, there was the mention about the importance of connectivity for export development. Dr. Sanchez, in your presentation, you mentioned about the fact that while NAFTA has grown, Mexico has even seen faster growth in its bilateral trade outside of NAFTA. Dr. Coronado, you mentioned the increase in services as being the trend in the market. And my question actually has 2 parts. The first part is, where should we as a state be moving to move in the direction of the trend as opposed to chasing what's already gone? So where are the economic growth areas that as a state Arizona should be developing in order to participate in what comes next? Dr. Sanchez, my question, which is more oriented towards you, is with respect to this bilateral trade, are there any avenues open to a state like Arizona whereby it can benefit in the existing bilateral arrangements of Mexico to expand this connectivity that was talked about in the first panel?
Gentlemen, would you like to go for it?
Okay, well, we'll quickly point to two sectors. If you looked at the trade flows from Arizona, in particular this new data that we have for Phoenix, for example, so I want to bring it a little bit closer to home. There's 2 sectors in there that actually dominate trade flows or exports produced out of Phoenix, and that is transportation equipment and computer and electronics. So those 2 sectors, if you looked at the US-Mexico trade flows, are the 2 sectors that dominate a significant portion of trade in North America. And so I would encourage, and I would imagine that then Arizona should be leveraging on that existing activity they have to continue to grow even that further. I mean, you have a significant auto operation south of the border in Hermosillo that I'm sure this part of the world, this part of the US actually takes advantage of that. But to the extent this region can actually leverage that, it will continue to be even a greater part of the North American market as far as trade flows is concerned.
Governor?
I wouldn't like to point out to specific sectors or opportunities which are, I think, you people have a better understanding of the possibilities for business between Mexico and the U.S. But I would like to to say that, you know, across the border between the U.S. and Mexico, there is a huge opportunity to make the border transactions more expedited. You know, the transport to be less expensive, you know, in terms of time, in terms of bureaucracy. So I imagine that once we make this connectivity, geographical connectivity, even easier, then a bunch of new business opportunities will emerge. But I wouldn't like to, you know, to limit the specific possibilities to certain sectors.
Well, you all look hungry, and the clock on the wall up there says that it's time for lunch. So thank our impressive panel for the presentation. And I'll turn it back over to Master Gold.
Oh, my goodness. Well, thank you. What an impressive panel. I think we would all agree that each person on this panel could be a keynote speaker themselves in another program coming up, and hopefully you'd think about us and this wonderful audience. So thank you again. Thank you. If in the audience you have any questions that you'd like to ask our distinguished panel, don't hesitate to email us at the GIC, and we'll make sure the questions get there to hopefully get a response to. I would like to note 2 or 3 little things, one of which the luncheon is in room 211, and it's around the corner when we leave here today. The other things I would like to mention, certainly I'd like to acknowledge, having joined the audience, as Paul Thomas. Please stand, Paul, member of the board of GIC, chief economist from Intel Corporation. And also we have been recently joined, and thank you for coming, Mayor John Lewis of Gilbert. So is Mayor here? Please stand for just a second. Thank you, Mayor, for coming today. I want to apologize for that noise. Hopefully it's been taken care of, and please enjoy lunch, and we'll see you after lunch.